Welcome to Remarkable Retail Podcast, Season 9, the Accountability episode. I'm Michael LeBlanc.
And I'm Steve Dennis.
Today, as we look to wrap out the fantastic season that was just whipped by, we revisit, as is our tradition, Steve's predictions for 2024, with part one of a two-part series looking back at the retail year that was and grading yours, powers of logic and foresight.
Oh, yes. As I always say, I'm no retail prophet, but I do put myself on the line. And I feel like if you're going to do that, you should actually have a little bit of accountability.
You've just got back from a bit of vacation, so you got a bit of a scraggly throat. So just if folks are wondering how and why you sound different. But speaking of travel, you've got some news for the people. You're heading to the city once described by many as the Paris of the East, Bucharest. What are you doing there? And do you have space in your luggage for any podcast partners?
Don't know about that, but yes, I am headed to Bucharest, Romania, my first time in that country, for an event on February 5th, probably a little bit chilly that time of year, but it is a retail media summit, which is sponsored by the folks at Footprints AI, one of the big AI players around the world. And it's a full day event. I'm going to defer to a large degree to some of the real experts on retail media, like Andrew Lipsman, who's been on the pod, who will be one of the speakers. And then our mutual friend from Microsoft, Shish Sridhar, will also be there, plus several other people. We'll put a link in the show notes so you can see what that event is all about. Now, this is by invitation only, so you'll need to contact the folks at Footprints to see if you can get in. But yeah, I'm looking forward to that.
Fantastic. Now, and you also have news from a city that is often mistaken for a European capital, Las Vegas.
Very easily to get confused whether you're in Venice or Paris, or of course, unless you've actually been to Paris
Venice or Paris.
Then you recognize it right. But yes, I will be once again gracing the stage at Shop Talk in Las Vegas. So more details to come on that. But that's a little ways off. That's fantastic. In the spring. But and we might have some podcast news to share about that in the new year.
A quick reminder, in case you missed our special bonus episode featuring Manchester United and our friends at Scale. Incredible numbers, 270 million social media followers. And we brought Man U some luck on the weekend on the pitches. They beat Manchester City in the Derby, so hopefully they'll give us some credit for that and, share.
I mean, that's really the only explanation.
It's really. Anyway, it's a fantastic episode. What a story, and don't miss that. We released it on the weekend, which is not something we usually do, but it's a fun bonus episode, so we thought we'd do something different. Now, before we get to part one of our 2024 retail predictions and review episode, let's dive into this week's most important retail news, brought to you by Scale, the world's fastest growing enterprise commerce platform. Learn more about their solutions at scale.com. That's SCAYLE.com. Let's start a bit at the macro. I don't know where to start in terms of the economy. There's so much. It's like a big jump ball. We're thinking about it up here in Canada. I know there's a lot of thinking going on, to say the least, in the U.S. What's your sense of where we're going to land and interest rates? We just did a big cut here in Canada, 500 basis points. What are you thinking?
Well, I think we've all learned that it's been very difficult, at least the last couple of years, to predict where things are going to go. So I'm not going to say too much about this because I don't know that I do, and we have a ton of news to get to. But I think what people will be just hearing about as they listen to this episode is whether or not the Fed decides to cut interest rates. And I think the predictions are that they will. But the growing sentiment is we might only get a couple of interest rate cuts in the coming year. So that obviously has a lot of effects on things like whether the home market will recover. We'll have a story about that in a second. But, really the big variable, as we've talked about, so I won't really say much about it, is just what's going to happen with the Trump administration.
Yep. One thing we do know, the biggest merger in U.S. supermarket history is dead, killed by the FTC. Were you surprised? And we've certainly got some news about how much they spent to do this. The lawsuits are flying. What are you thinking?
I'm only surprised from the standpoint that it took this long. This deal was announced in October of 2022. So they've been working on this, and the FTC has been looking at this from apparently many perspectives, and ultimately decided to kill it. Yeah, what you're referring to is we did learn that the two grocers spent more than $800 million on merger fees, which is quite quite a lot. So good for the lawyers and the accountants and the management consultants, but not.
I like that phrasing, quite a lot. It's almost like $1 billion, for God's sakes. It's crazy.
Yes.
Man, right?
So, there's a lot of debate, which is probably a different podcast about what exactly counts for anti-competitiveness. But you've got two huge grocers. Their claim is they needed to come together to really fight against Walmart, which has become or has been a huge grocer for a long time and is only growing its share. So, but in any event, the deal appears to be done. Albertson has turned around and filed suit against Kroger for, quote, repeatedly refusing to divest assets necessary for antitrust approval, ignoring regulators' feedback, rejecting stronger divestiture buyers, and failing to cooperate with Albertson. So probably not unexpected at this point. But yes, I guess we can move on, and the grocery world will remain a bit less consolidated, at least for some time.
On the other side, I guess, of the deal book, it looks like Saks Neiman Marcus deal is closing. What are you reading in the tea leaves? I'm not hearing much about it other than it's, I'd be surprised if it closed by the end of the calendar year, but who knows, right? What do you think?
Well, we did. I think a couple of weeks ago, we reported that the rumors were that they were about to close. The thing that happened this past week is that HBC, the parent company of Saks Fifth Avenue, secured a $2.2 billion loan, basically a junk bond, which was necessary to be able to close the transaction. So typically, securing financing is one of the last steps in making a deal like this happen. So I think that's the reason why people are pretty convinced it's going to go ahead quickly. So who knows? Even by the time people hear this, it may have gone. But I agree with you. The end of the year, Christmas time is a little bit strange time to do it. But maybe people want to get that done so they can enjoy their holidays with their family. I don't know. But two things really I think that are interesting about the financing. One is that they were originally looking for $2 billion, and they ended up raising that by $200 million because there was such strong investor interest. Now, I don't know that the strong investor interest relates to this deal being a fabulous deal. It may relate to the fact that they can get 11% interest, which brings me to my second point, which is, as we've commented on before, we'll end up talking about in our, because this was part of my predictions. There's a lot of things that make this deal a bit questionable in terms of the operating aspects of it. One is it seems like both Neiman's and Saks' operating performance hasn't exactly been great. As we've talked about a bunch of times recently, the luxury market is really slowing down. And, the competitive environment continues to get greater. Not only do we have players like Mike Teresa growing share online, but the vendor stores, Louis Vuitton stores, Prada stores, et cetera, continue to open. And I think that's been part of the reason why it's been hard for both of these players to grow the top line. So now they're going to take on a lot of debt. And I can tell you, when I was at Neiman Marcus and we did the first leverage buyout some 20 years ago, I guess now, we were always worried about the massive debt payments that suddenly appeared on our balance sheet. And I can tell you our interest rates was a lot lower and our EBITDA margin was a lot higher. So my headline, what could possibly go wrong?
Now, we also have news about Walgreens. So there's talk about them going private with someone I know, the Sycamore Partners. They oversee Staples here in Canada, did a great job of that in the U.S., and they took the Lowe's business, and Lowe's exited Canada, and they now own a company called Rona. So very active and very savvy. What do you make of it, and do you think this would be a good partnership?
Well, Sycamore is definitely a very experienced retail private equity firm. As you mentioned, they've got a ton of investments, a bunch of other brands that people would recognize, like Ann Taylor, Chico's, et cetera. We've also, this is kind of like going back to some of the stories we've been talking about all year, all the turmoil in the pharmacy market, Walgreens, CVS, others, Rite Aid closing stores. So this is not necessarily a deal without a ton of risk. We don't know any of the terms at this point or the likelihood that it will go through. So I think more to come on that. Probably we won't know a heck of a lot more for a bit, and we'll see what their plans are. One of the things I thought was interesting when I was reading the story, and it wasn't something I'd really focused on, was if you go back to 2015, Walgreens had a stock market value of $100 billion. Today, the company is worth only $7.5 billion. So I just didn't realize how far it had fallen. So I guess one way you could look at it is, here's a chance to get a great brand with some great assets at a fire sale price.
Sure.
Or it could be, catching the proverbial falling knife. So, but I think we're, a lot of speculation just about, and obviously some of these stories we just talked about, a lot of speculation about the number of deals really starting to increase, particularly as we go into the next year. But maybe that'll be one of my 2025 predictions. You'll have to stay tuned for that.
Macy's back in the news, a little more clarity, if you can call it that, around this whole accounting, bookkeeping fiasco, plus more activists popping up out of the woodwork. Talk about it.
Yeah, well, one thing's pretty easy to talk about. The other one's a little bit more to it. As we talked about, they asked to have a couple of weeks to send out their earnings because they needed to restate them based upon this accounting issue, fiasco, you might say. And so they did that. Really, all that happened, as expected, was they went back for the time period and added in those expenses. So their profitability, which wasn't already that high, was a bit lower, but again, not huge to the total. But basically what they announced, which I'd say is the more sanguine sort of piece of news, is that apparently this low-level accountant made an error, apparently kind of an honest error, so to speak, and then proceeded to cover it up in subsequent quarters. So there was no real malfeasance, apparently, nor was this person going to get anything out of it, which was part of what we talked about. We couldn't understand the motivation. Apparently, this guy or gal just screwed up, and in order to not get caught, kept perpetuating the misstatement for a couple of years. So anyway, as they say, it's always the cover-up. But I think for the fourth time in, I don't know, some number of years, maybe a decade, an activist group has emerged again. This time it's the Barrington Capital Group and Thor Equities, two firms I really don't know much about. They, again, like many others, have seen most of the value, if not all of the value in Macy's being the retail real estate. They actually want to do two major things: split the company into a retail operating division and a real estate holdings firm. And they really want to slash the capital investment and really look to take a lot of expenses that are going into executing the turnaround strategy that Macy's is now coming up on a year. We've talked about this a little bit in the past, so many listeners may be familiar with what I'm going to say about this, so I'll try to make it quick. But I think, the bottom line is it's really difficult to work out how you can extract so much value from the real estate and continue to be a retail operating company. Because if you do a bunch of sale leasebacks, the retail operating company is unlikely to be able to afford the debt. If you really don't put capital back into the business, you have no chance of improving the performance to any large degree of the retailer. So to me, this is just basically a way to do a moderately paced liquidation of the company. Now, as I also have said in the past, it's possible that that is the best answer for shareholders. But we should just be clear what's being proposed here, that if this deal goes through, I think you can expect Sears Part 2, which is that Macy's will sink into the oblivion, probably faster than happened with Sears for a bunch of reasons. But in any event, so I would assume that the company is not going to take this offer seriously, but they have a fiduciary responsibility to go through the motions, as they did with the one just 6 months or so ago. But we shall see. But yes, any deal like this is basically deciding to liquidate the company over time, as far as I'm concerned.
Interesting. Let's talk about TikTok. I think of this. They lost a lawsuit judgment last week that said that they can still be sold or banned, I should say, January 19th. One day before the Trump inauguration. And I hear two things. I hear, huge numbers coming out of the TikTok shops in America. But at the second, I don't hear anything. Like the silence speaks volumes. Like I don't hear about anybody trying to buy it. It's like this date's coming. This train's coming. The Canadian government just shut down all TikTok offices and everybody had to go home because they shut them down. What's going on? What do you think? I mean, I guess this gets to your predictions episode, but what are you thinking about TikTok right now?
Well, as I've said, and I'm hardly an expert on this, but it doesn't mean I don't have strongly held and educated opinions. It's just hard to imagine politically how the government is going to let TikTok go away. I think it's just such a big platform. So many of their constituents are going to go nuts if TikTok stops operating. So it seems to me like something's got to happen here. I think the most likely, well, there's two likely scenarios. One, which is pretty obvious because TikTok is appealing this, which is that that date will move out many, many months as this goes to the Supreme Court or whatever happens. But I also think there are, and it's been rumored, that there are plenty of people waiting to buy TikTok. So if I had to guess, I would say that this is going to get kicked down the road. But it also wouldn't surprise me if on January 18th somebody emerges as a buyer. But I think the odds that TikTok stops operating, maybe there's something that happens where it goes dark for a number of days, basically, as the U.S. government tries to force ByteDance to take a deal. Obviously, ByteDance does not want to do this, but they're not going to walk away. It's hard for me to imagine they're going to walk away from the enormous profits that TikTok generates in the U.S. So.
I don't know. I'm not sure it's all up to profits for that organization, for ByteDance and for its Chinese masters, who will be attending the day they'll be in America on the 20th, apparently. So, all right, let's turn our minds to earnings. So the earnings cavalcade continues. Let's start with one of my favorite retailers, Costco.
To a certain degree, Costco is more of the same. The other two are maybe a little bit more newsworthy, but Costco, continues to do well, gaining share. They had a 7.5% sales increase, which was 5.2% comp, which was driven by very strong foot traffic. E-commerce, their growth there continues to be really nice, up 13%, great profitability. They're going to continue to open more clubs. So obviously a huge retailer already, but they're going to open 26 clubs in the next year. And I think this just goes back to something we keep coming back to, which is the concentration of spending. We're seeing just a lot of retailers, and we'll talk about this in one of my predictions, so I'll keep it brief here, but we just continue to see this concentration among some of the big players, while kind of the second tier players are lucky to even have sales increases.
Let's move to Canada, to Vancouver, for Lululemon, who thinks that new stuff will help their sales.
Yeah, well, one of the big stories of the year was a couple of the most famous retailers in the athleisure space, like Nike and like Lululemon, did not have a great year. But Lululemon did bounce back in the most recent quarter. By the way, I will disclose that I do own some Lululemon stock, which I bought after the big dip. I'm still not in the positive tune, but or positive territory. But
you're in downward dog territory right now.
I'm in downward dog, but I'm looking to do my sun salutations next year as the stock comes back. But in any event, they did have a 9% revenue surge, which was a bit unexpected. Wall Street was a bit surprised by that, and their profitability trajectory was quite nice, and they were pretty optimistic about the holiday season. But the thing to point out is that the U.S. continues to be quite weak, which is by far their biggest market. It was really international that where they have newer stores that really drove this number. So I think for Lululemon really to get back on a greater trajectory, we need to start to see some growth in the U.S., but that's not there yet. And then the last one I wanted to talk about is one of our favorite retailers, but definitely one that has continued to be caught up in all the challenges in the home market. It's RH. And one of the things, Gary Friedman, I often recommend people go and read his commentary on the quarter because it's both insightful and amusing typically. But one of the things he was saying was, as a positive, was that they managed to generate strong top-line growth despite it being the worst housing market in 30 years, his words. They had a 8% sales increase. They swung back to a profit. So they're definitely standing tall amid pretty much all the players in direct competitors, as well as anybody, the Home Depot, the Lowe's, and others in the broader home market. Expressed quite a bit of confidence about the end of the year, as well as going into next year. They expect a 22% increase in the fourth quarter with strong margins. And even though their sales, I think we've commented on this in the past, even though their sales have been weak the last year or so, like everybody else, their margins continue to be pretty darn good. Many people would kill for their profitability margins. So if they can maintain those margins and really start to draw or start to drive the top line, it's a pretty interesting story. But the other thing he said, which I think is something we've come back to on occasion, is if you've got a great balance sheet, if you fundamentally have a strong business model, tough times are actually the times to kind of step on the gas. So one of the things he said is they look at this as a great opportunity to grab market share. So it's pretty clear they grabbed market share in this last quarter, and it looks like they're really going to go for it going into next year. So a bit of a surprise there, but an encouraging story.
Well, all right, that's a wrap on the news. Thanks again to our friends at Scale, world's fastest growing enterprise commerce platform. And let's now get into our super interesting annual prediction review. All right, we are back. Well, we never really went anywhere. Our 2024 predictions review, the Baker's Dozen. We'll be doing this episode in two parts because there's lots to go through. And Steve, this is not a new thing that we've been doing. Talk about the history of what we do here, your predictions, and then looking back. And it's a nice way to wrap the year in a fun and interesting way, right?
Well, I'm a little bit biased, but hopefully the audience will find it fun and interesting. But I started making predictions, 7 or 8 years ago and sharing them through Forbes as a senior contributor there, and then, reposting that on LinkedIn and so forth. But we then carried that over to the pod, where I make the predictions in January. So we'll be doing that again, I guess, in about a month or so. Mm-hmm. And then coming back and being accountable. So hopefully this is gives us an opportunity to make some broader commentary about the year that was, but also to the extent that I didn't get them right, I can feel chastised or whatever, but maybe there's something to be learned from the drivers that I assumed and that maybe others assumed that didn't come true.
All right, well, let's dive in. Number one, the bifurcation, i.e. polarization, of just about everything accelerates. What's it about, and what did you observe in 2024?
Yeah, so I think with each of these, I'll do three things. One, just remind people. They can go back and find the Forbes article if they're interested. We'll put the link in the show notes if they want to read a little bit more about what this was about. But I'll kind of explain what was behind the prediction, what actually happened, and then give myself a letter grade. So many people who follow my work will know I've been talking about retail's great bifurcation for quite some time, not only in articles, on the pod, in my book, etc. And really, when I first started talking about it, it was about the struggles of the mediocre middle. So we saw a lot of strength on the value end of the equation, a lot of strength on the higher end or specialty luxury end of the equation. And that has continued to be true to varying degrees for the past decade. But this year I was trying to make the prediction that not only is that still true, but we're seeing more polarization or bifurcation in things like financial performance. So we've talked about Abercrombie and Fitch for an example there, where even though apparel has been pretty tough for most, particularly in the more affordable apparel arena, there are still people that are able to generate great financial results. We just finished talking about RH.
Yep.
Category very tough, profitability very tough, but RH is able to stand out. But even things like malls, regional malls, where the A malls for the most part continue to do quite well, just about all others struggle. In the office space arena, not so much a retail story, but in commercial real estate, we see a lot of the best properties doing well, but anybody less than the very best continuing to struggle. So that's really what it's about. And what I would say from how this turned out, for sure, the struggles in the unremarkable middle continue. And you could make the argument, even though, many of the players that I was originally thinking about 10 years ago when I first started talking about this have either gone away or are shells of their former selves. We clearly see, and we'll come back to this in another prediction, but department stores all had terrible results, all with negative comps and difficulties with profitability. Store closings have picked up, though. There's still plenty of store openings. You then, as we talked about with Abercrombie and Fitch, but you continue to see Costco. We just talked about Amazon, Walmart really do well. Certain specialty retailers continue to do well. Sephora, we had their president just on the pod a couple of weeks ago. Hoka, Warby, the luxury brands. And, most of the other results of this kind of tale of two cities across retail, this has really been playing out, I think, quite clearly. So I would give myself an A on this one. The only reason why I might not go A plus is I actually thought some of the more on the store closings or bankruptcy side, we might see a little bit more action. But who knows? Oftentimes, right after the holidays, we see those kinds of announcements come out. But anyway, I have to grade myself now, so I would say an A.
All right. For many brands, flat is the new up. What does that mean?
Well, this relates a little bit to some of the things we just talked about. But, as we've seen this discretionary recession, as some folks call it, we're definitely seeing the pressure that many consumers feel from inflation. So even though inflation is ebbing, we still see prices that are, way, way higher than they were 2 or 3 years ago. We see dollars that are going to rent, healthcare, things that are really non-discretionary that are forcing spending. One of the charts I saw recently was the percent of growth among services compared to goods. And in the U.S., growth in goods overall has been pretty flat, where there have been nice increases in services. So things like travel, going to a Taylor Swift or Beyonce concert, these kinds of things. Mm-hmm. And, as we talked about in the news, the home market has been mostly frozen. So in this constrained spending, unless you are a strong player delivering essential goods or somebody really unique, it's been very difficult to drive the top line. And we've really seen that play out. Again, we've talked about this concentration among relatively few big retailers. So Walmart, Amazon, Costco accounting for nearly 50% of all incremental spend. But big ticket has been down across the board. So the Home Depots, the Lowe's, the Best Buys of the world would be very happy to be flat. Mm-hmm, mm-hmm. The department stores would be very happy to be flat, but they've been down 5 to 10%. Even dollar stores, which you would think is a value player, have struggled to keep pace and drive any sales. Most of apparel and footwear is weak. Luxury growth is decelerated. So it's really a picture of, for the majority, I haven't seen an exact count, but I would say the majority of retailers of any size have not been able to drive positive comp store sales because of this macroeconomic backdrop and because a relatively small number of players are gaining significant market share.
Yeah. C, prediction number 1. All right. What do you give yourself?
I'd give myself an A here as well. This has definitely played out largely the way I expected to. Again, here, to the extent I wouldn't give myself an A plus. I did think that inflation might be even a little bit worse than it's turned out to be. But I think the main thing was that I thought consumer credit conditions might deteriorate more markedly. But overall, we've seen the aggregate amount of spending still be pretty solid. And I thought that might be a bit weaker, so some of the impacts would be a bit more pronounced.
Well, we are many minutes into our episode. We haven't said the words AI yet, but it is time to talk about AI. It's on the lips and thoughts of pretty much every retailer. And your prediction was this time it's personal. Talk about it.
Yeah, what I was trying to get at here is, I certainly think AI, generative AI in particular, is going to have huge impacts over the long term. What I thought about this year in particular was we would see, as we largely have, some automation of pretty rote tasks. So some of the business cases that are generating, some real impact are more on the efficiency side. But on the effectiveness side, I thought the bigger opportunity, or at least the more obvious opportunities in the near term, were going to be around personalization. Unfortunately, and this is one thing I think I've talked about in every predictions episode, is that, and I think I've gotten better at it, but it's still sometimes hard to really have the precise data to give myself a real grade. So this is a bit more anecdotal than things like comp store sales and profitability that comes into some of the other predictions. But I think there's a ton of evidence, including some people that I work with, that there's lots of experimentation going on. I think it's also pretty clear that the tech providers, though this isn't specific to personalization, continue to up the ante on investments, often in some pretty mind-blowing ways. We've talked about most of these, Amazon with Anthropic and so forth.
Building nuclear reactors to power their AI programs.
Exactly. Google's had a bunch of news throughout the year about some of the, and Apple about some of the kind of increases their clients are getting by using AI. Again, not necessarily specific to personalization. Sundar Pichai at Google said, the CEO of Google said that more than a quarter of the company's new code internally is now generated by AI. And just really recently, AI, the so-called agentification of search is part of what Google has started to talk about. And I think we'll be hearing more about that at NRF. But I don't think you can really see a significant of large-scale adoptions where you could really say this is moving the dial in a significant way for a significant number of retailers. And there's a little bit of anecdotal evidence of some disillusionment maybe creeping in that the results are not going to happen quite as fast. So anyway, long wind up to saying, I think I'd give myself a B- on this. Lots of experimentation, but not as much tangible results as I was expecting or hoping.
This one might be because of framing. I mean, I do see, as you do, and talking to retailers, there's a bit of fatigue. It's like, okay, the easy part's done. Now we got to really tuck in. But the consumer-facing mass personalization, I don't think that's gone so well. But I think there's some big progress behind the scenes. So maybe if you would have reframed, the personal piece, I think is just the harder piece, a much harder piece. And I'd call everyone's attention to Air Canada, who had a AI agent that promised a deal that didn't exist. And, they were forced to offer it.
Oops. Yeah.
Oops. Sorry for that hallucination. But there you go. Anyway, so I think B- is fair, but maybe a little tough, anyway. So I thought there's some pretty good progress. The D continues to come out of DTC, one of my favorite phrases, but there's some exceptions. Talk about this one.
Yeah, so I'm sure most of our listeners would know it. The D in DTC is direct consumer. And so what this was about was that for many of the disruptor brands that were really relying almost overwhelmingly on their direct-to-consumer strategies, so both their online business as well as their own stores, really I was characterizing this as the focus on profits over growth would become stronger. So part of that was to explore wholesale as a lower cost way to grow. The other piece, though, which gets more of the kind of traditional direct to consumer that we've seen from vertically integrated brands like, Land's End, Abercrombie and Fitch, those kinds, American Eagle, those kinds of companies, but also from some of the manufacturers, whether we're talking about luxury players like LVMH, but also folks that have been around for a long time, Carter's, Levi's, et cetera, and some of the newer brands like On, Yeti, Hoka. So, and then, the new part is really what some folks call, not that we need any more acronyms in retail, MTC or M2C, manufacturer to consumer, a different form of
China
that
Direct.
Because, the China Direct model like Temu and Shein. So there's a lot behind this, and I think we have to make sure we understand when we say D2C, we don't necessarily mean the digitally native vertical brands. They're part of it, but not on everything. So what I would say has happened is largely what I expected. Profitability continues to be elusive for many of the newer D2C digitally native vertical brands. So Stitch Fix, RealReal, Rent the Runway, Allbirds, et cetera, really have pulled back on some of their spending. It's largely resulted in revenues going down or really decelerating. And so they're still struggling to get to profitability. But some, like Allbirds, but a number of others, have been trying to emphasize wholesale channels more. So that's still kind of a work in progress, but definitely the push in different distribution channels, not going direct, going through wholesale is definitely in evidence. Manufacturers, again, whether we're talking about the luxury brands or the Carters, Levi's, et cetera, continue their push, not only elevating their direct-to-consumer e-commerce efforts, where most of these have seen outsized growth from their online business, but also opening quite a lot of their own stores. So we talked about the luxury vendors continuing their push there multiple times. But, folks like Levi's, folks like On, Hoka, opening their own stores. I mean, the big exception here, which we've talked about enough that I won't spend any time on it, is what's been going on with Nike. Nike went too far in this direction. They're recalibrating, and we'll see what the new year holds for them. And then, the biggest factor by far has been the extraordinary growth of Shein and Temu. Their growth has far outstripped really anything else we've seen in the direct-to-consumer world. So overall, I would say give myself an A-. To the extent I graded myself down a little bit, I thought we might see more wholesale activity or strategic partnerships between the disruptor brands and kind of traditional wholesale. And we've seen some of that, but not quite as much as I had in my head when I put this one together.
All right, number 5. And this one, the culling of the once and future unicorn herd. I was with you on this one. There's a song by Vanilla Fudge from the 60s, Keep Me Hanging On. Like, this one goes through my head when I was thinking about the unicorns. Like, how on earth is Allbirds still around? I don't get it. What's going on?
Well, you're right. I mean, I'll skip ahead and say I gave myself a C on this one because it did not play out nearly to the degree that I thought. But yeah, I mean, we've talked about wobbly unicorns on the pod for a couple of years here. Last year, I described it as more of a reset, which largely had to do with what we talked about above, which was many of these disruptor brands were pulling back on their spending, pulling back on their store expansion plans. But this year, I thought we'd see more of a reckoning. So that meant either bankruptcies, refinancing, major management changes, retrenchments, write-downs, whatever.
Yeah, whatever.
And we've seen some of that. Zulily, Neighborhood Goods, Schofield, some fairly high-profile brands have gone away or in a different ownership structure. A handful of others. The stock performance of many of these high-profile brands has generally been pretty poor. Exceptions are brands like Hims and Warby Parker and a handful of others. But yeah, we didn't see nearly as many hit the wall as I expected. The reason is largely because some of the focus on profits over growth has actually started to work. But the biggest reason, and frankly, it was not something that I spent enough time on, it was a little bit more intuitive than data-based, is many of these companies, because they went public a number of years ago, actually have a fair amount of cash on the balance sheet. So you mentioned Allbirds, which did stop opening stores, closed 14 stores, which is like a third of their stores. And I suspect in a few weeks here, we'll be hearing about some more store closings. But they had a decent amount of cash on the balance sheet. So even though they were still continuing to hemorrhage cash, many of these folks have been able to reduce their burn rates to live another day. So you have a situation where you've got a few companies that are edging towards the precipice. Whereas others, it's not so bad. And if they can really reduce the burn rate, doesn't mean they're going to be a successful company, but it might give them an opportunity to get to a point where they could be acquired or, do some other thing. So overall, the picture of the big name disruptors of the last 10 to 15 years is pretty poor in aggregate. But yes, this is definitely not nearly the reckoning I expected. And, but a few of them, I'm sure, Allbirds being one of them, we'll be talking about in an early part of the new year because they've definitely got a lot of work to do to stick around.
All right. Our 6th and last prediction for this episode, but don't forget we'll be back with part 2. Honey, I Shrunk the Store Again. What was this all about?
Well, the reason I wrote Honey, I Shrunk the Store Again is that I've written in the past, several years ago, about this idea of shrinking the stores, and I talk about it in my first book, Remarkable Retail. So now, obviously, a few years have gone by, and when I originally wrote about that, it was this idea that we would see both kind of prototype concepts being downsized to deal with the reality of a digital world, and in some cases, just weaker productivity, but also different formats, smaller store formats to execute more of a hub and spoke strategy. So, for example, what IKEA is doing with their design studios, or what Macy's is doing with both the Market by Macy's type concept and the Bloomies concept, to kind of be what some folks call preemptive distribution, get closer to the customer, but with a format that's got different economics. Same thing with some of these urban stores. So expected this to kind of pick up pace for a whole bunch of reasons, really. In terms of what happened, these small format concepts continue to grow, but we haven't really seen, we've seen a few announcements of some experimentations.
Yeah,
We've
IKEA,
definitely seen some opening. Yeah, IKEA for sure. Macy's is continuing to open these small format stores, but not at a really rapid pace, which suggests to me probably the performance isn't that great. But for example, Bloomingdale's announced they're going to be opening a Bloomies concept here in the Dallas area, and Bloomingdale's has not had full-line stores in Texas for quite some time, I believe. So, there is some confidence there. We definitely see, as some of the big players that are expanding, that many of their prototypical stores are smaller. And, when you can shop online, I think some of that just is about improving the economics of a brick and mortar location. A few big anchor stores like Nordstrom's have been shrinking their stores. So here, another example in Dallas, they went from a 3-story store to a 2-story store. I hear rumors that several more of these kind of projects are out there. The most obvious one in terms of shrinking, but it's not exactly what I meant by this, was that these big malls are repurposing quite a bit, adding residential, healthcare, pickleball, whatever it might be. We don't have good numbers on this, but it's definitely going on. But that wasn't really so much what I meant by the shrinking of the store. But, that's going to make sense for a lot of malls where the productivity is not that great. And there's just a lot of basically Walking Dead kind of retailers taking up a lot of space. So overall, I'd give myself a B. I do think one of the reasons, but not the only reason, that this hasn't happened a bit faster is inflation continues to be pretty high, which makes the cost of executing these projects sticky. And similarly, the pace of interest rates hasn't come down as fast as I expected going into the year. So that's going to make some of these projects a little bit harder to get off the ground, but maybe we'll see what I do with my 2025 predictions, but maybe this was a better 2025 prediction than 24.
Well, and for those who are joining us in New York, be sure and if you have a chance, go see the Home Depot's new urban store. They opened it up in a Bed Bath & Beyond up on 61st, and actually very close by on 3rd is Whole Foods Market Daily. I visited both, and the Whole Foods Market Daily is an interesting store, very small. I mean, they both fit in what you're talking about for different reasons, particularly the Market Daily store. So again, we'll be in New York and at NRF, and if you have a little time on your hands, do check those two out. All right, well, that's a wrap on this episode, part 1 of our accountability episode, I guess we could call it. We'll be back shortly with part 2, so stay tuned. Take care. Thanks for tuning in. New episodes of Season 9 will be available each and every Tuesday, so be sure and tell your friends and colleagues in the retail industry all about us. If you liked our episode, please take a moment to give us a 5-star rating on Apple Podcasts.
And I'm Steve Dennis, strategic advisor, keynote speaker, and best-selling author of 2 books, Leaders Leap, Transforming Your Company at the Speed of Disruption, and Remarkable Retail, How to Win and Keep Customers in the Age of Disruption. You can learn more about me, my consulting, and keynote speaking at stephenpdennis.com.
And I'm Michael LeBlanc, consumer retail growth consultant and advisor, keynote speaker, and media entrepreneur. You can learn more about me on LinkedIn. Safe travels, everyone.